He describes himself as the rose amongst the thorns. And I think it's because, you know, he's the only man on our team. So, you know, being the odd one out, he feels he's the rose and not the thorn. Bruce will be discussing some amendments contained in the draft tax administration laws amendment bill and some recently decided tax cases. Our last speaker is going to be Anushka Thilakdari, who's also a senior tax advisor on my team. She's also an accountant by training. She appears to be very sweet and accommodating, but under that sweet exterior, there's a core of steel, so be careful. I've been privileged to work with Anushka and Bruce for the last 15 odd years. I think I'm giving away our ages a bit. The gray hair is starting to show. And I have to say it's really been a privilege to work with them and continue to work with them for so long. You know, it's been a difficult time over the last few months with COVID-19 and so on. And I think one of the things that this experience has shown us is that we really need or we really value the human interaction. I am not known to be the most sociable of persons, but I have to say that I really do miss having the face-to-face interaction with clients. And I'm quite glad that we're now starting to get, you know, a bit more normality in the sense that we are able to meet clients on a limited basis, but nonetheless, face-to-face interaction is far better than a Zoom or Teams meeting. Before we get to the nuts and bolts of the tax details that we want to talk about, there's a few housekeeping matters that I would like to just draw your attention to. As participants, you are all automatically muted. Unfortunately, we'd love to hear you, but we can't have everyone talking at the same time. And the chat functionality has been disabled. But you should be able to ask any questions on the Q&A tab. So if you have any questions, please type it in, click on the Q&A tab and type in your question. We will look at the questions at the end of the webinar. So after all the presentations have been done, and time permitting, we will answer as many as we can. If we're not able to, please feel free to contact either myself, Bruce, or Anushka. We're happy to entertain any queries thereafter. We expect the webinar to last approximately 1.5 hours, including questions. Hopefully you won't get bored and will stick with us for the duration. We are recording the names of the attendees and we'll be issuing CPD letters to all attendees. So if you do not receive your CPD letter, please contact us. You know, we may perhaps not have your email address, but I think we should have everyone on our database. Finally, this webinar is being recorded and a copy will be available on our website later. And our website is www.bowmanslaw.com. Of course, if you you know, find having trouble accessing it, please feel free to contact us and we'll point you in the right direction. Now, for myself, one of the things that it's really worthwhile thinking about is what is our normal legislative process? And normally what happens is that in February of every year, we have the budget speech, which continued as normal this year. And we had, actually, it wasn't an unpleasant budget speech. I mean, the tax amendments that were announced weren't terribly bad. And it was a pleasant surprise in that some tax relief was afforded to taxpayers and so on. And there were some major announcements that were made, but you know, overall, it was well received. One of the things that our economist presenter did mention at our budget speech event was he said, you know, yes, we've got the budget speech, but you know, we haven't really factored in what the impact of COVID is going to be. And he was quite right. I think within a space of a month, so the budget speech happened at the end of February, and by the end of March, we were already on stage 5 of lockdown, and it had a huge impact on the economy. And all the planning, the fiscal planning that we had at that point really went out the window. Our normal legislative process is we have the budget speech. It's followed by draft legislation, which is released in July of every year. It goes through a consultation process. We normally get the draft, the finalized draft legislation later in the year, and it's introduced into Parliament for finalization. This year has been somewhat different because besides the fact that we do have draft legislation that was released in July as planned, in between, we also had other pieces of legislation like the disaster management acts and so on that were promulgated, which contain some tax amendments as well. Some of those amendments are still applicable, even though the majority of the lockdown has ended. Anushka will be picking up on some of those issues later on during her presentation. So before we get into the nuts and bolts, some comic relief. I don't think SARS has much of a pot left, or if it's got a pot, it's really quite empty at the moment. I think the announcement has been that there's going to be a 300 billion rand hole in our tax collections this year. And I think that's a frightening number, especially since, we were already short when we had the budget speech, we were already far short of what we were required to, in order to basically run or pay for government expenditure. So our debt bill has really gotten out of control. From a SARS perspective, what we've seen, what we've experienced over the last few months is that when the lockdown happened, SARS went really quiet. So there wasn't much in the way of SARS queries and so on. I think their concentration was on two things. One was modernizing their system so they could work with taxpayers remotely or by electronic means. And the second was to release refunds as soon as possible. So that's what they were concentrating their efforts on, and we didn't see much in the way of audit queries and so on. One of the things that came out of the lockdown experience has been that the VAT refund fraud has escalated. And it's obvious, if SARS is releasing money as soon as they can, the chance of fraud being perpetrated is actually quite, much higher, right? What we've seen since the lockdown has eased, we've seen an uptick in SARS queries. They're certainly a lot more active than they used to be, and I think we can expect a lot more SARS activity in the coming years. They're certainly going to be looking for more money. I think what we're also going to expect is a harder line on penalties being imposed and less of a chance of getting those penalties waived. So I think what's really going to be very important for taxpayers is to make sure that when they submit returns, the returns are as accurate as possible, because even a mistake could end up in penalties being imposed, and those penalties are expensive in a lot of cases, and the chances of getting them waived now is going to be a lot more difficult than it used to be. Not that it was an easy process to start with. Now, in terms of what I'll be looking at today, I'm going to be discussing some amendments that are contained in the Draft Tax Laws Amendment Bill. These are the substantive changes that are proposed to our legislation, our tax legislation. A lot of it is income tax related this year. I've said it before and I'm going to say it again. South Africa really does have a first world tax system for a third world country. Whatever is new and topical internationally, we want to be the first to implement it. And I think we lose sight of the fact that our economy needs a lot of support. We need simplicity, but unfortunately, Treasury is not receptive to that. They're so fixated on anti-avoidance and so on. Every year, the Tax Act just gets thicker and thicker. I recently did a podcast interview for MoneyWeb, and it was really related to tax compliance and small businesses. And one of the things that shocked my interviewer was, I said that, well, for me, even if you're running a small business, it's very difficult to do your taxes yourself. You have to you're almost obliged to have a tax practitioner help you, because the laws are so complex that it's very difficult for someone who's managing a business, trying to get their operations right, to also manage their tax implications as well. And I think that's an indictment on our tax system, that we can't make it easier for taxpayers to comply. I'm again giving away my age. When I was studying, maybe a couple of decades ago, the tax handbook was one volume and it was quite thin. Now it's 2 volumes and 2 substantial volumes at that. So it gives you an idea of what has happened over the last 2 decades or so. Now, in terms of the nuts and bolts of the changes that we're looking at, when it comes to individual savings and employment, and that heading, there's a few amendments that I just want to pick up on. Now, clearly, the amendments I'm talking about today is not a full spectrum of what is actually contained in the Draft Tax Laws Amendment Bill. And the reason for that is some of the amendments are not really applicable to my client base, so I haven't really touched on them. But you must just be aware, there are some amendments related, for example, to long-term insurers, minors, things like that, which I'm not going to discuss today. What we've selected are those topics that we think are going to be of interest or more applicable to our client base. But just bear in mind that you may need to, if you've got a more specialized industry, you may have to look at the Draft Tax Laws Amendment Bill yourself to see if there's anything else that could be could impact you. Now, from an individual savings and employment perspective, there's a change related to employer-provided bursaries. So currently in our tax legislation, there is an exemption for income tax purposes for bursaries provided by an employer to certain employees' relatives. And those employees are typically those people that earn less than 600,000 a year. And obviously there's financial limits as to how much that bursary could be. Now, according to the budget speech, Treasury wanted to clamp down on certain schemes, salary sacrifice schemes, to provide bursaries to employees, relatives. So what happened is that, you know, why they relaxed the bursary rules in the first place was to encourage employers to fund school fees and so on for their employees' children, especially like the lower end, so that, you know, the burden on the state is not that high. And there were certain enterprising sort of consultancies that came out with salary sacrifice schemes. So in other words, if you were earning 200,000 a year, your employer would say, okay, fine, I'll pay you 190,000 as cash remuneration, and 10,000 Rand I'll give you as a tax-free bursary for your child to go to school. And what happened was that that employee would then be taxed on 190,000, not 200,000. From an employer perspective, nothing further or nothing more was coming out of the employer's pocket to fund this, because he would have had a cost of to company for that employee of 200,000 anyway. And I don't think that was the intention behind the legislation or the relaxation. The intention was for additional funding to be put into employment, into education, and not for you know, the fiscus to actually fund these kinds of bursaries. Now, the pendulum has swung quite far in the other direction. So the amendments that are proposed are actually quite onerous, and it really, I think that it's a lot more. I think the reaction, it's a bit of an overreaction to what they wanted to attack in the first place. So there's two amendments to the exemption sections. There's two exemption sections that deal with bursaries. The one is section 10.1Q and the other one is section 10.1QA. And essentially the two amendments that are proposed there is that, firstly, bursaries cannot be provided by an employer on a salary sacrifice basis. So if it is on a salary sacrifice basis, that exemption will not apply. Right? The second amendment takes it a lot further. And essentially, if an employer wants to be able to provide bursaries to employees' relatives, they need to also provide similar bursaries to members of the general public. Now that, I think, is a bit uncalled for. I think it would have been sufficient to say that, you know, the employees' bursaries cannot be done on a salary sacrifice basis. You know, it's forcing employers to either stop schemes altogether, not fund employees' relatives, or make it open-ended, which I don't think a lot of employees will be able to, and especially in this environment, to be able to afford. The other amendment related to the employer itself. So if the employer is wanting to claim the deduction related to the bursary provided, that's going to be removed. That the deduction will not be allowed if there was any element of salary sacrifice. So, you know, it's not only taking away the exemption, it's disallowing the deduction on the employer side. So it's quite clear. This is, you know, the policy position that they want to take. But as I said, I mean, it's a bit more onerous than it should have been. I don't think it was necessary to actually say that all your bursary schemes have to be open schemes. You know, I think we're going to see a lot of employers not wanting to fund relatives' studies any longer. In terms of effective date, it's going to be effective on the 1st of March 2021. So there is still some gap or time for the salary sacrifice schemes to actually run out for the current year. According to the budget speech, it was meant to be effective on the 1st of March 2020, but, you know, with COVID and so on, it got pushed out. The next amendment I want to talk about is regarding reimbursements of employees to employees for business travel. Now, currently, the Income Tax Act makes provision for advances or reimbursements from an employer to an employer for meals or incidentals, if that stay is away from home for at least one night. And, you know, the amounts that you can provide to your employees tax-free cannot exceed the amounts that are gazetted in a government gazette. Now, when it comes to trips that are day trips rather than overnight trips, it's not taxed, the reimbursement is not taxed if the employee can prove that they incur the expense on the instruction of the employer. And an anomaly will come up when you don't really have an explicit instruction from employees, just like take it for granted. You know, you're going out of town on a business, you're going to go, say, for example, to Newcastle for the day, you're going to buy yourself lunch, you can claim that back from your employer. You know, it's taken as given that it would, and that has to go through an approval process, right? So there's no explicit instruction, you will go to Newcastle and you will buy yourself lunch, right? Now, the Tax Laws Amendment Bill contains an amendment to exclude for income tax purposes any reimbursements for meals and incidentals on a business day trip, provided the employer's policy allows for reimbursement. So all you have to do is really demonstrate that you've got this policy of reimbursing employees. And again, the amount cannot exceed what is in the government gazette. And that's only going to be effective from the 1st of March, 2021. Then related to immigration, and I think this is quite a hot topic at the moment. I think with South Africa's position being what it is, word of mouth has it that a lot of people are looking at immigrating. And one of the issues related to immigration is being able to basically cash in your assets, your South African assets, because often you do need that money to set yourself up in the next country. Now, currently, well, it was, announced, that the Reserve Bank is looking at relaxing exchange controls. And they don't really want to deal with so many approvals. I mean, for every immigration, they have to deal with approvals and so on to do for people to take their money out of the country. And I think they want to reduce that burden on the Reserve Bank. But what they replace it with is a more onerous tax regime. Now, currently, if you want to withdraw your retirement fund, you can do so if the immigration has been recognized by the Reserve Bank. So the moment it has been recognized, you can take all your retirement funds and leave the country. Now, with the Reserve Bank not being involved in that process any longer, there's a new test to make provision for the payment of lump sum benefits. And what it says is that, well, what the proposed amendment is that when a member of a retirement fund ceases to be South African tax resident and has maintained that for a period of 3 consecutive years, then he can access his retirement funds. What this means is that it delays your access to your own funds for up to 4 years. And it's quite onerous, especially if you do need those funds in order to set yourself up in the next country. There is a gap, so if you want to immigrate, you must do it before the 1st of March 2021, because beyond that, this new rule is going to come into effect. Then with regard to the employment tax incentive, employment tax incentive is really colloquially called the youth employment incentive. And it's really for those employees that are below a certain age, I think it's 29 years old, and they earn less than 6,500 a year. A month. And the employer can claim an incentive for employing or providing employment to these employees. Now, there is currently an anomaly in the legislation. Essentially, to claim the incentive, that the employer has to be compliant at the time it's claiming the incentive through its PAYE return. And the anomaly is that if you, let me take a step back. For a compliant taxpayer, you have until February and March, so the end of February and the end of August every year in order to be able to claim your ETI for the reconciliation period that's covered in that 6 months. Now, for non-compliant taxpayer, the irony is that you can't claim the allowance or the incentive while you're non-compliant. But the moment you become compliant, you can claim back for those periods that you missed. So you're not sort of restricted to 6 months, at a 6-month period during which you need to claim the incentive. So they are making that change so that non-compliant taxpayers are not better off than compliant ones. And the amendment is to say, well, if you become compliant, you're only able to claim the incentive that is within that PAYE reconciliation period. And the change here is meant to be effective when the TLAB was published for public comment, and that is the 31st of July, 2020. So it's almost like retrospective legislation, this one. Then quite a big change related to trusts. So a few years ago, legislation was implemented to attack interest-free or low-interest loans provided by natural persons to trusts and to companies owned by trusts. And what this was meant to do was, to prevent or, well, previously interest-free loans weren't regarded as donations. And the change that came in was to say, well, if you provide an interest-free or low-interest loan to a trust to finance, its operations or the acquisition of assets, then, the interest-free component is going to be regarded as a donation, an annual donation, and you're going to have to pay donations tax on it. So the natural person annually has to pay donations tax on this deemed interest benefit. Now, one of the ways to structure around it is to transfer the assets of the trust into a company and convert that loan to preference shares. Now, Treasury has become aware that preference shares are quite widely used, and from what I understand, a lot of preference shares have been used for this purpose have borne zero coupon. So in other words, the companies are obliged to pay any dividends on those preference shares. Obviously, if the company was obliged to pay preference share dividends, dividend tax would become payable, and it wouldn't be an issue for Treasury. But what they were concerned about was the fact that no dividends were being paid either. So, it was almost had the effect of it being an interest-free loan, but it just didn't have the form of being a loan. It was in the form of preference shares. So essentially the change that is coming through this year is that they're wanting, if a company is funded by preference shares, and that company is owned by a trust, then that company, the subscription price of the preference share will be deemed to be a loan. And any dividend that's paid thereon is regarded as interest. And if that interest or that dividend is less than the official rate of interest, then you will have a deemed donation in the hands of the natural person at whose instance that loan was provided. Right? So in this case, then, if you've got a preference share that has pays dividends at less than the official rate of interest, then you're going to have a donations tax implication for the natural person that's involved in this scheme or arrangement. This is meant to be effective on for years of assessment commencing on or after 1st of January 2021. Now, obviously, being tax consultants, we've got ways around it. I can't tell you what those ways are in this forum. If you're looking at restructuring your trust and looking at maybe avoiding a Section 7C problem, please feel free to contact me, but I can't tell you what my solution is right now. Now, moving on to the corporate tax side. So there's quite a few amendments proposed on this side. And there are some notable sort of omissions from our the Taxation Laws Amendment Bill. So there were two announcements that were made in the budget speech that didn't make its way into the amendments this year. And the reason for that is both these amendments have been pushed out. They were meant to come into effect earlier. They've now been pushed out both to 2022, and primarily because of COVID and its impact. Right? Now, the two amendments to be aware of, and I think it's important to bear this in mind because it's going to have quite widespread impact to a lot of corporates. The first is related to the utilization of assessed losses. Now, the idea here was to broaden the tax base. The number of we have a lot of companies that are registered in South Africa, but a lot of them don't pay any tax. And the primary reason for that, well, besides being dormant, a lot of companies being dormant, one of the main reasons why a lot of companies don't pay any tax is because they're carrying assessed losses. So in an attempt to broaden the tax base, the proposal was that if a company makes taxable income in a current year, you can only use your assessed loss to offset 80% of the taxable income. So effectively, the company would pay tax on the 20% remaining amount of taxable income. And that cash will obviously be paid to SARS as tax. So effectively, you're broadening the tax base. What this means is it doesn't mean that your assessed loss is lost. It just means that it's going to be utilized over a longer period of time, assuming that you do generate taxable income in future years. Right? Now, it was meant to come into effect on the 1st of January 2021. As I said, it's been pushed out to 2022. But if you've got any assessed loss companies in your group, just be aware that this is coming. So you may have a cash flow impact for some of the companies for that particular entity once 2022 comes along. Then with regard to corporate interest deductions, right, we do currently have limitation of interest deduction rules in our legislation. And in the context of multinational companies, it generally applies to connected person debt, and where the interest, foreign connected person debt, and where the interest is not subject to withholding tax. Now, one of the things that has been a problem internationally, or something that has been discussed internationally, was this whole idea of limiting interest deductions that may be claimed by companies. I think the preference is for companies not to be heavily geared, right? Now, on the day of the budget speech, a document was published setting out what Treasury's thinking was on this issue. And the document is not quite clear because it's still subject to the consultation process, but one of the issues really is that it seems from our reading of it that if you are part, or a company is part of a multinational, so if you've got a subsidiary offshore, if your holding company is offshore, whatever, right? Even if all your borrowing is local, so none of it is connected person, none of it is foreign borrowings, even if all your borrowing is local, these interest limitation rules will apply to your company, right? So something to be very careful of, and especially if you're undertaking transactions that you expect to gear, just be aware that these interest limitation rules are being proposed. Obviously, it's subject to a consultation process. I know that Bowmans, as well as organizations such as SITE and SICA and so on, are participating in the consultation process. So hopefully some sanity will prevail. For me, it doesn't make sense that you would have interest paid locally, which would be taxed in the recipient's hands, but you would just not get the deduction on the in the borrower's hands. It doesn't make sense, or make sense or sit well. This is meant to come into effect on the 1st of January 2022. Then some technical amendments, and this is to correct an anomaly that's currently in our legislation. So our legislation currently caters for asset for share transactions and asset for debt transactions. So where you transfer an asset to a company in return for the issue of shares, or in return for the issue of debt, so the establishment of a loan account in your favor, right? Now, the anomaly that arises is that currently the asset for debt transaction is not subject to the connected person rule, which says that transactions between connected parties needs to be at arm's length unless you're applying rollover relief, right? So to correct this anomaly, what they're proposing is to remove from Section 40CA the reference to asset for debt transactions, because asset for debt transactions, actually the normal rules related to capital gains tax should apply to those transactions anyway. So there's no need for a special rule. We did need a special rule for asset for share transactions because of the Labat Africa case, where the court ruled that, payment of consideration through the issue of new shares wasn't actually, there was no expenditure incurred by the company, so the company couldn't have a base cost for the asset that it acquired. So it was to correct that issue, but for debt, we don't have that problem or anomaly that we need specific legislation for that. That proposal is meant to come into effect on the 1st of January 2021 and apply to acquisitions on or after that date. Then some also quite technical amendments related to rollover relief provisions. Now remember, rollover relief applies generally to transactions in a group situation, and really what it is meant to do is to delay the triggering of any tax under certain circumstances, right? One of those circumstances, if you have intra-group transactions where you transfer assets between companies within the same group of companies as defined, right? Now, as with all benefits, it comes with lots of strings attached, and Section 45 of the Income Tax Act has several anti-avoidance provisions. Two of these provisions are the degrouping. So if you've got a transferor and a transferee company within the same group, and they end up not forming part of the same group within a period of 6 years, or they deem to degroup because your consideration is transferred outside of the company, outside of the group, then you will trigger the tax as if the tax had applied at the time of the transaction, right? We have further anti-avoidance rule, which says that if you finance that intercompany transaction through the issue of debt, so on intercompany loan account, in other words, right? that debt has a nil-based cost in the hands of the transferee company. So in other words, if you had to dispose of the debt outside the group, and not through the repayment of debt within the group, in those kind of circumstances, you would trigger tax at that point. Now, one of the problems that arises is that you could end up, if you trigger, both anti-avoidance rules, you could have a double tax. So for example, if the degrouping happens and the group has now to have to make good on the tax that would have been payable had they not applied rollover relief, it doesn't take away the fact that that debt does not have a base cost any longer. And potentially you do have, additional tax if that debt is then realized. Now, one of the amendments is to try and alleviate that burden. And really the amendment says that if you trigger the tax on degrouping, you will now have a base cost for the loan, which I think is fair. It's effective for years of assessment commencing on or after January 2021. Now, regarding Section 46, which really relates to unbundling transactions, and this we see a lot in the listed environment. We've had companies unbundling, listed companies unbundling, shares in subsidiaries and so on. And one of the restrictions is that in the legislation is that you can't have more than 20% of the shares in the company that's unbundling being held by disqualified persons. So in other words, so if you look at a company that has got a subsidiary, if it had to dispose of that subsidiary, it would be subject to CGT, generally. That's the implication, right? Now, the way the rollover relief provisions work is that it provides rollover relief, or it doesn't trigger the tax on the transfer of that subsidiary shares into the hands of the shareholders, right? Now, what if the shareholders are not South African taxpayers? Because, for example, they're exempt, or they're foreigners that will not pay tax if they had to dispose of their shares. So I think there's a concern that, by allowing a tax-free unbundling, you are eroding the South African tax base. Right? Now, the way the legislation is worded is that a disqualified person, is defined as a person that holds 20% of the shares in the company together with connected persons, whether alone or together with connected persons, right? But it's a disqualified person. So what that means is that you could have like maybe 100 foreign persons holding shares in South Africa, in a South African entity, a listed entity, who have in aggregate more than 20% of the shares. But technically at the moment, it would still qualify for Section 46 rollover relief. And the change now is then to say, if in aggregate you have more than 20% of your shareholders being disqualified persons, you can't have that as a tax-free transfer under Section 46. Now, in speaking to some of my colleagues that deal with unbundling transactions at a listed level, they say that effectively what this means is almost none of our local listed companies can actually unbundle any shares anymore, because a lot of them do have foreign shareholding that exceeds 20%. So, it's going to really affect the market in a negative way. And I think they may be right. Just thinking of some of the listed companies that I've dealt with over the years, a lot of them do have more than 20% foreign shareholding. That's besides looking at the exempt South African taxpayers or exempt South African shareholders as well. Then something that's a bit more related to cell captive insurance and so on. So currently in our legislation, we do have Section 23L that says that if you've got sort of an investment insurance policy, right? So you cannot claim, and for accounting purposes, you don't show any, it's reflected as an investment. So in other words, your contributions or your premiums that you pay are actually posted to the balance sheet. They're not deducted through the income statement, right? In that case, you have to match the tax consequences to the accounting consequences. You can't claim the premium as a deduction if you are capitalizing it to the balance sheet, right? There is another provision in the legislation, Section 23C, that says that if you're recovering a loss that's covered by insurance, you cannot claim that loss as a deduction. So what it means for cell captive insurance policies is that you could end up with a double whammy. You don't get the deduction of the premium, and you can't recognize the loss on or damage, or destruction of the asset. So the legislation is going to be sort of made clear to say that Section 23C that limits your deduction on loss does not apply if you weren't able to claim your premiums under Section 23L, which I think is fair. The effective date of this amendment is the 1st of January 2021. Then moving on to doubtful debts. So doubtful debts, the legislation related to doubtful debts was revised quite extensively over the last few years. There's new rules related to banks. There's new rules related to other taxpayers other than banks. Right? Now, and a lot of it was necessitated because of the implementation of IFRS 9. Now, I don't pretend to know anything about IFRS 9 or anything much about it, except to say that the way your doubtful debt calculation is done these days is a lot different than it was previously. Right? Now, when a doubtful debt allowance is calculated for a situation where IFRS 9 does not apply, there is a concern that taxpayers are providing for debt that's also secured. Right? Now, having been in practice for a number of years, I find it very unusual. I mean, if a debt is secured, normally, your auditors won't allow you to raise a doubtful debt provision on that debt because it's not doubtful, you've got some security over it. But clearly, in some cases, they have seen this happen. So what they're doing is changing the legislation to make it clear that if you've got a provision or a doubtful debt provision related to a debt that's secured, to the extent that you've got security on that, you can't claim a doubtful debt allowance. And I think that's fair. I think they're just putting into legislation, I think, which is generally was practice in any event. Right? This is meant to come into effect on the 1st of January 2021 and applies for years of assessment commencing on or after that date. Then quite a big change for lessors. So currently, if you're a lessor in an arrangement and you apply IFRS 9 to calculate what your impairment is going to be of your lease receivables, you cannot claim a doubtful debt allowance on that provision, right? And the reason for that is your lease receivables actually is the gross amount of that you're going to receive over the life of the lease term, not only those lease payments that would have accrued to you already, right? And there's a concern, or there was a concern that taxpayers would be claiming a deduction for lease receivables that hadn't been effectively shown as income as yet, right? What the amendment that's going to come through this from 1st of January 2021 is that if you are a lessor in an arrangement, you do apply IFRS 9, you can only claim an allowance to the extent that the provision relates to lease payments that have already accrued. Right? And I think that's fair because you would have put that into income already, pay the tax on it, but it's now doubtful whether you would receive it. So I think that's fair. At least it gives lessors some ability to claim some level of their provision instead of nothing as it is at present. Then again, with doubtful debt allowances claimed by banks, right? So banks generally would apply IFRS 9 to calculate their impairments. And the concern here is that the provision may include amounts that would never be tax deductible. And things that come to mind here would be like financial guarantee contracts or provision for non-Section 8E preference shares and preference share dividends, for example. So you could impair that from an accounting perspective, but those amounts would not be deductible typically under Section 11A or 11I, right? So the amendment that they want to make sure or make clear this year is that your allowance is not available on an impairment for those items that would never be deductible under Section 11A or Section 11I. I think in practice, I do have some clients that are banks. I mean, in practice, we have been doing that. So when impairment is related to, example, preference shares, we haven't really been deducting those. But I think it's better if the legislation is clear on this aspect. It's meant to come into effect on the 1st of January 2021 as well. Then with regard to Section 24JB, and this typically applies, well, mainly to banks, but a few other entities as well. And they are referred to as covered persons. Now, there appears to be a scheme where a covered person, for example, like a bank, would form a special purpose vehicle which I think would be in the form of a company. And they would use that special purpose vehicle to convert income that would normally be taxable to dividends that are not taxable. And my understanding of how the scheme works is that the special purpose vehicle would earn interest on whatever monies that it lent out, or investment income or so, and would pay dividends to its investors. And the payment of dividends would be treated, I think, as deductible for accounting purposes. And that being the case, 24JB would say, from an accounting perspective, because you're a covered person, your tax treatment will follow your accounting treatment. So effectively, there was a deduction being claimed for dividends declared, whereas normally you would not get a deduction for that. And on the recipient side, any dividends received was normally treated as exempt, right? I think Treasury has picked up on the scheme, and what they're wanting to do then is to really expand on the exclusions to Section 24JB, which says that, at the moment, dividends received or accrued are not covered under 24JB. In other words, we don't follow the accounting treatment. That's going to be expanded to dividends declared as well, right? So in other words, we won't, for these certain circumstances, we won't follow the accounting treatment. The tax treatment, the normal conventional tax treatment will be followed. This again comes into effect on the 1st of January 2021. Then from the point of view of incentives, there were quite a few announcements made in the budget speech related to incentives. I just want to pick up on a few. One is related to the urban development zone allowances. Just to be aware that that's been extended to the 31st of March 2021. It was meant to come to an end in March this year. So there's an additional benefit for those people that are improving or building buildings in an urban development zone area. That's typically the inner city areas. Then with regard to special economic zone benefits. So these are the designated it used to be urban development zones or UDZs. They're now being called SEZs. And essentially, if you're operating an SEZ and you meet all the onerous requirements that are attached to that, you get a corporate tax rate of 15%, you get ETI, or you can claim employment tax incentive on all your employees, not only those that are younger than 29. And you have better write-offs as far as building allowances and so on goes. Now, the benefits are meant to be realized over a 10-year period. And when the legislation was brought into our Tax Act, the idea was that it would be effective around 2014 and then come to an end in 2024. But there was a delay in switching on the legislation, and basically the effective date was pushed out. So what they've said is, well, in order to get or provide that 10-year benefit that we had promised to taxpayers, they will push out the date of cessation to 2028 as well, right? Which is a benefit. So if you have companies or you're operating in a special economic zone, there is a longer period that you can claim the tax benefits. Then with regard to the venture capital company regime, remember this regime was set up to incentivize investors to put money into small businesses, so venture capital. And the uptake wasn't great at first, and primarily because you really have to be a contortionist to meet all the requirements of being a VCC, right? But having said that, there are a lot of companies that have eventually set up VCCs, and they primarily, well, they're not really funding small businesses as I think it was intended to. They're primarily operating like in the hotel industry or as student accommodation and some schemes in agriculture as well. Now, the sunset date is meant to be the 30th of June 2021. And remember, the benefit that an investor got was that if you invested your capital into a venture capital company and you met all the requirements, you can get a deduction of your investment. And so that was quite nice for at least high net worth individuals to reduce their tax burden, right? Now, as I said, you really have to try very hard to meet all the requirements of the VCC regime. And I think one of the concerns Treasury has got is whether it's really been effective in driving the economic change that they want. So what they are doing at the moment is they haven't said whether or not it's going to be extended, but they are conducting a survey. So if you are involved with any venture capital companies, I suggest you participate in that survey to give your input, because I think that will really drive what we see in legislation on this issue in the coming months. Then from an international tax perspective, You know, there's a change related to the a changing of residence of a company. So we've got currently in our legislation, when a company ceases to be tax resident in South Africa because it decides to move its place of effective management offshore, the company will be liable for exit tax on its assets. So that's currently in our legislation. Right? Now, one of the concerns is that once that company becomes non-resident, if a South African shareholder has a significant interest in that company, that is more than a 10% shareholding, it is possible for that shareholder to dispose of their shares in that company and not trigger any tax in South Africa. Whereas if you had disposed of shares in a local company, obviously CGT would be an issue. Right? Now, the amendment that they want to put through is to deem South African shareholders to also have disposed of their shares in a company that's changing its residence. Right? So we have two levels of tax for CGT or income tax, you know, on recoupments and so on its assets at the time it ceases to be resident. And the shareholder will also have to then regard that as a sale of the shares at that time, and will have to account for any CGT thereon at the time that residence ceases. It's quite onerous, but you know, you almost got to understand why this legislation was put in place. My concern with it is that they haven't restricted it only to those people that have or likely to get that participation exemption. So it's almost worded to say basically all shareholders, even if you own a minor share in that company, you will be impacted by this legislation. Then from a transfer pricing perspective, so if you're in a multinational group and you have got controlled foreign companies in your group, one of the changes to the transfer pricing legislation is that transfer pricing rules are also going to be effective or applicable to transactions between controlled foreign companies. Right? And where it will be an issue is if a South African resident benefits because of the transaction, it has a tax benefit as a result of the transaction between the CFCs. So I scratched my head a bit and thought, well, what kind of scenario could this potentially apply to? I suppose if you've got a supply chain and you've got in that supply chain two controlled foreign companies, and there's you put on a big margin on some goods that are transferred between those entities before those goods reach South African shores, you know, you could end up trapping a bigger margin outside the country. So your cost of your goods coming into South Africa is higher, right? Which means you would have a higher tax deduction in South Africa. And potentially from a CFC perspective, it means that you potentially have no income to attribute because of the exemptions that apply, right? So one of the, so just to be aware of, especially if you're part of a multinational group, you do have CFCs that have transactions between each other, and eventually those transactions impact someone in South Africa. You'd have to be careful to include that as part of your transfer pricing analysis. Again, this is effective on the 1st of January 2021. And also from an international tax perspective, loop structures. So currently, you know, loop structures are sort of monitored by the Reserve Bank. They're not keen on a situation where South African takes out money from the country and then reinvests it back into not only the country, but into the CMA region, so the Common Monetary Area, right? Now, the Reserve Bank, as I said before, is trying to relax the exchange controls. And in order to compensate for the relaxation of exchange controls, they're putting quite onerous tax rules in place. It's almost to discourage the formation of any loop structures. Right? And there's two amendments that are being proposed. The one is, if you've got a controlled foreign company outside of South Africa, and that controlled foreign company has received dividends from a South African entity, you cannot exclude those dividends when you're calculating the net income that has to be attributed to the South African shareholder of that CFC, right? Now, what this doesn't take into account is the fact that those dividends that arose from a South African entity would have been subject to corporate tax at 28% already. You may have paid dividend tax on that, and you may have to attribute that income back to another South African after that. So you could end up paying 70% plus tax on the same income because you've got a loop structure. Further amendment is that the CGT participation exemption will not apply on the disposal of the shares of the CFC. So currently, if you own more than 10% of a foreign company and provided certain requirements are met, for example, you must sell to a non-resident and so on, you don't have to pay CGT on the disposal in South Africa, right? That participation exemption will be removed for these kinds of CFCs that have South African assets as well, only to the extent that the value of that CFC is derived from the South African assets, right? So in other words, I think they want to make group structures so unattractive, it doesn't really pay for taxpayers to actually have these in place. Effective 1 January 2021 again. Then there's an amendment which I don't know whether it's necessary, and it seems like it's a bit overboard. So this is one where you've got a listed security that's listed on the JSE, and you now want to transfer it such that you are the listing or onto the register of foreign exchange. So generally, it would be those companies that are dual listed. So instead of trading via the JSE, you would trade, for example, on the London Stock Exchange or so. And the proposal here is that the moment you change which register you're going to be on, so you don't have a domestic listed security anymore, and you're listing on an exchange that's outside of South Africa, then they want to introduce a deemed disposal. So it's almost like you're changing residence. Now, the irony of the whole thing is that South Africa runs or has a resident base of tax, right? So if you're a South African resident, even if you have a foreign listed share, you're still going to be taxed in South Africa. That's not going to change the position at all. So, I think it's a bit overboard, but this is the proposal that if you want to change the exchange that you're working off, then you're going to have to pay the tax upfront. And then at the later stage, if you dispose of those shares in the future, then the future appreciation would be taxed again or taxed at that stage. Again, effective on the 1st of January 2021. Then from a VAT perspective, remember last year, one of the big changes was that Section 72 of the VAT Act was overhauled a bit. And Section 72 dealt with rulings. So rulings that, taxpayers could apply for if, they needed a specific, there was an anomaly or a difficulty that they had to overcome. This year, there's 3 amendments that are coming through because of the amendments to Section 72. They say that we'd rather put these things into the legislation rather than dealing with it via rulings, right? And I'm only going to pick up on one of them. The one change that they want to make is that if you've got a cross-border lease of a foreign-owned ship, aircraft, or other equipment for use in South Africa, so your lessor is offshore and the goods are being used in South Africa, and where the lessee imports the goods for use in South Africa, and the lessor is not South African resident and is not a vendor in South Africa, it is proposed that basically the lessor does not have to register for VAT in South Africa, right? Now, one of the big changes or the big things I think to make this work is that they have to almost force the lessee on importation of those goods into South Africa needs to declare the VAT on the importation of those goods. So that's the twist to the tail. So the lessor doesn't have to register for VAT purposes, but the lessee has to pay the VAT on the importation of the goods. This is meant to come into effect on the 1st of April, 2021. Then from an export tax perspective, if you remember the budget speech, they were introducing a new tax on scrap metals, export taxes on scrap metals. And I think it's to discourage the export of scrap metals and rather have those scrap metals available for our local foundries to recycle or refine further, right? So if a taxpayer is involved in the export of different types of metals, there is going to be a tax that's going to be imposed per ton. The most expensive being red metals, I think, such as copper and so on, which is going to be up to 8,400 Rand or so a ton on export. And just to be aware that that comes in on the 1st of March, 2021. So that's me on my side. I'm going to hand over to Bruce, who's going to take us through the tax administration amendments as well as some recent tax cases. Thank you for joining us. I'll speak to you guys later. Just give us a few minutes while we change over screens. Bruce, you can put your video on.
Good morning, ladies and gentlemen. Apologies for the delay. As Yasmeen said, our age reflects our use of technology. My name is Bruce Bosch. I'm a senior tax advisor at Bowmans. Excuse me. I've been at Bowmans from the 1st of January 2019. Today, I'm going to share with you certain cases and propose amendments in terms of the Tax Administration Laws Amendment Bill. Okay. Just in terms of a joke, you'll see. I think what's missing from this screen is the shark circling around the island. And you'll see the sharks will depict SARS in terms of the legislation that they intend, or Treasury they intend proposing in the draft, basically in the draft Tax Laws Amendment Bill. Okay. Okay. One of the proposed amendments by Treasury is the amendments of Section 187 of the Tax Administration Act. The effect of this amendment is the result that erroneous payments that will be made by taxpayers to SARS will only start accumulating interest from a period of 60 days from the date of payment of the payment that the taxpayer has made. So effectively, where a taxpayer has made an erroneous payment to SARS, the taxpayer will only receive interest on that amount after a period of 60 business days, which is effectively 3 months if you take business days into account as defined in the Tax Administration Act. So you won't get, if you made a payment, R1 million payment to SARS erroneously, no interest will accrue up until for a period of the 60 business days. And then if SARS decides to refund you thereafter, the interest accrue period will start ticking from the 61st day at the end of the day. And you know how long SARS takes to refund payments. So they'll basically make use of the full 60-day period. In our view, it's inconsistent with the common law principles relating to interest. It's also potentially unconstitutional because in terms of Section 195 of the Constitution, we must ensure the efficient, effective, and economic use of resources to provide services impartially, fair, equitable, and without bias, and to respond to the needs of taxpayers. So in doing so, SARS has basically had use of taxpayers' money, interest-free, and only has to refund it after a period of 6. Again, it can refund it after a period of 60 days without interest being paid to the taxpayer. As you can see, the teeth are out. Sharks are lurking in the waters. Okay. In terms of the advanced and private rulings, Section 186 of the Tax Administration Act is amended in terms of subsection 2. If the advanced ruling is a binding private ruling or a binding class ruling, SARS must first provide the applicants with notice of the proposed withdrawal or modification and reasonable opportunity to make representations prior to the proposed decision. This is a good amendment because it allows taxpayers and SARS to correspond in terms of the proposed ruling that will be issued. It's more a consultative process and makes the process to be more efficient and effective. We have experienced this with rulings that have been applied for on behalf of our clients. We SARS initially disallowed or gave an adverse ruling, but when we had approached them and provided them with more facts and more the reasons why we wanted the ruling, they eventually turned around and said they agree with what we proposed and provided us with the ruling that we had requested. So it allows the process to be more consultative, and it allows for more efficiencies within the process. So it comes into operation when the tax administration laws amendment bill is promulgated. Okay. Then in terms of criminal offences, SARS wants Treasury in terms of paragraph 30 of the 4th schedule to the Income Tax Act and section 58 of the Income Tax Act and section 234 of the Tax Administration Act, wants to remove the words willful and without just cause. By removing these requirements that the conduct set out of the above mentioned sections must have been willful in order for the taxpayer to be found guilty of committing an offence. So by removing these words, willful and without just cause, it gives SARS more ammunition to prosecute taxpayers for errors that have been made in their submissions. Okay, so the word willful is not defined in the Act, but refers to a deliberate or intentional act. So by removing it, it allows easier prosecution and allows SARS to seek to criminalize petty mistakes that are made. I mean, we're all human at the end of the day, and we do have finger trouble sometimes when preparing documents and making submissions to SARS. So SARS wants to, by taking those words out of those paragraphs, wants to make it a criminal offense where you make a silly mistake at the end of the day. Okay. The draft proposal is intended to facilitate the prosecution and potential prosecution of minor errors, which basically do not cause any harm to the fiscal regime. Okay. The main concern is that SARS and MPA, basically the National Prosecuting Authority, do not have the current resources financially and from a manpower point of view to take on much more volume of cases if this amendment comes to fruition. So you can see that SARS is basically SARS and Treasury is basically targeting basically the weaker parts of the population, where they should be going after those people that have committed the real offenses within our system, those people that have received extravagant cars for their birthdays, have been paid for for their birthday parties, and that using state resources. I mean, the manipulation of the tender process in terms of the procurement of PPE, and those are the criminal offenses that they should be attacking, rather than the people, the normal average guy in the street who's going to make basically an error when submitting a document to SARS. So you can see the teeth are already out. Okay. Then in terms of the proposed amendment to section 95 of the Tax Administration Act, Treasury proposes amendments as follows, where SARS may make an original, additional, or reduce a jeopardy assessment based in whole or in parts on an assessment if the taxpayer does not submit a return. So where taxpayer does not submit the return, SARS can make an assessment in terms of additional, reduced, or a jeopardy assessment, where it submits a return of information that is incorrect or inadequate and failed or to submit relevant information requested by SARS under section 46 after receiving more than one request for such material. So SARS can go ahead, where they've requested information from a taxpayer, they can go ahead, and the taxpayer is not furnished with this information to SARS. SARS can go ahead and make an assessment based upon the information that they have at their disposal. Another introduction to section 95, which is after subsection 3 of the section. The making of an assessment under subsection 1 does not detract from the obligation to submit a return of the relevant material. So if SARS had made an assessment, if you have not submitted the information and SARS has made an assessment, it does not detract you from still forwarding that information to SARS at the end of the day. You're still compelled to do so. Okay? An assessment under subsection 1 is not subject to objection and appeal unless the taxpayer submits the return or the relevant information and SARS does not issue a reduced assessment. So you still have to submit that information to SARS at the end of the day. And it's not the assessments under subsection 1 will not be subject to objection on appeal unless you submit that information. Okay, in terms of paragraph B6, the taxpayer in respect of whom the assessment under subsection 1 has been issued may within 40 days from the date of the assessment request SARS to issue a reduced assessment or additional assessment by submitting a true and full return of the required information or relevant information. So it's compelling you within that 40-day period to then provide the information as requested by SARS. And the period may be extended by SARS, by a senior SARS official if required to. Okay. It comes into operation when the Tax Administration Laws Amendment Bill is promulgated. Okay. In refunds, so in terms of section 190 of the TAA, SARS need not authorize a refund as required in subsection 2 until such time that a verification, inspection, audit, or criminal investigation of the refund in which the court is in accordance with Chapter 5 has been finalized. So where SARS is doing the verification, inspection, or audit on your tax return, and there's a refund due, or you will not receive that refund until the process has been finalized. And this comes into operation when the Tax Administration Law Amendment Bill is promulgated. Okay, so SARS is basically holding on to the monies. They don't want the monies to basically flee at the end of the day, so they keep that money as basically a security. Okay. In terms of the tax cases that I'm going to be dealing with today, one of them is Telkom versus the Commissioner of SARS. Okay. Just a background in terms of the case. During the period 2007 to 2009, a subsidiary of Telkom had acquired the entire shareholding of a Nigerian company, telecommunications company. During that period, Telkom had advanced loans to the Nigerian entity, which eventually amounted to about $531 million. During the 2012 year of assessment, the entity, the subsidiary of Telkom, had disposed of the shares, all the shares in the Nigerian entity, to a third party. Telkom had disposed of its right to those shares, to the loan of $531 million. For consideration of $100 to the same third party. Okay. The issue in dispute was the interpretation of Section 24I. Okay. Section 24I basically deals with gains and losses in respect of foreign transactions, and requires that the taxpayer either include or exclude your foreign exchange gains or losses, subject to certain provisos contained in the section. Okay. So in terms of Section 24I, Section 24I has a number of definitions, and the most important definition in this case was the ruling exchange rate. So what the ruling exchange rate means in relation to foreign currency, in relation to foreign currency transaction is where the foreign currency transaction is basically a loan or advance. Or debt in a foreign currency, the amount that must be used is the spot rate. Where's the date of transaction? It'll be the spot rate that must be used. Where's the date of translation? It must be the spot rate that is used. And where's the date of realization? You must use the spot rate. And the SCA basically stated that the issue in dispute between the two parties was the determination of the ruling exchange rate at the date of realization of the loan, which meant that either a foreign exchange gain or foreign exchange loss would be included in the income of Telkom. Okay, Telkom submitted basically that in terms of the proviso to the ruling exchange rate, I'm going to just read it out to you quickly. The proviso stated that provided that the rate prescribed in respect of a loan advance or debt in terms of this definition is the spot rate on the transaction date or the spot rate on the date on which such loan or advance or debt is realized, and the consideration paid or payable or received or receivable in respect of the acquisition or disposal of such loan or advance or debt was determined by applying a rate other than such spot rates on transaction dates or the dates realized, such spot rate shall be deemed to be the acquisition rate or disposal rate, as the case may be. Okay, so what's the SCA stated was that the difference between the two opinions was the determination of the ruling exchange rate at the date of disposal of the loan by Telkom. The Telkom submission was that the proviso to the definition of the ruling exchange rate applied to the facts and circumstances of its case, and that a rate other than the spot rate had been used in calculating the foreign exchange gains. Okay, so if you see in terms of the proviso, it says that a rate other than the spot rate. So Telkom submission was going on that basis, that they had used a rate other than the spot rate in determining the foreign exchange gains or losses. Okay, it was argued by Telkom that the $100 received by Telkom as consideration for the disposal of the loan, was clearly not determined by applying the spot rate, but a rate other than the spot rate. And accordingly, the 100 Rand consideration was the rate that was used. Okay, it further went on, Telkom further went on and submitted that the rate should mean an amount paid or for a price of such things or group of things. So it's basically, they're saying that the amount paid, the price paid or charged for the loan, which was 100 Rand, was the rate that was used in the calculation of the foreign exchange gains or losses. Okay. The SCA basically stated that in their findings, that Section 24I deals with gains or losses caused by foreign exchange fluctuations and is not applicable to business losses as business or commercial losses as incurred by Telkom. When the proviso to the definition of the ruling exchange rate is interpreted in the context of the section as a whole, the use of the word rate means the exchange rate which reflects the value of a particular currency. It is the currency rate and not a discounted rate that is contemplated or envisaged in this provision. Okay. Okay, so in order to satisfy the requirements of the proviso that the consideration must be determined by applying the rate, the consideration would have to be the result of a process of the calculation, which utilized the rate as a factor in achieving the result. And this could only be achieved by comparing two rates, the foreign exchange rates, to achieve this, the end result of the consideration. Okay. In its final submission, that SCA has basically stated that consideration of the loan of $100 was the agreed or perceived value of the loan between the two parties and did not take into account any currency exchange rates in determining the price of the loan. And accordingly, their submission, Telkom submission, had failed on that basis. Okay. There's been a number of changes to Section 24I. And the subsequent amendments was that foreign denominated debt that went bad, any foreign exchange gains or losses relating to the debt that was previously included or excluded from income must be reversed at the end of the day. Okay. Okay. Then further issue in dispute between Telkom and SARS was a Section 23H. So Telkom had made a cash incentive bonus payment to Velocity for connection of its clients in respect of contracts which we entered into between Telkom and its customers. The effect of this was that Telkom, the connections were made on behalf of Telkom, and the debtors were Telkom's debtors at the end of the day. And the period of which the subscription agreements between the customer and Telkom was a period of 24 months. Over and above this, Telkom had paid Velocity commissions over the period of the subscription agreements as well, besides the initial connection fee. So Telkom had claimed a deduction of 171 million Rand in its tax return in terms of Section 11A. When SARS reviewed the agreement and the amount claimed as a deduction, they limited the deduction in terms of Section 23H. So Section 23H effectively limits the deduction claimable in respect of certain expenditure, where the benefit in respect of that expenditure accrues to the payer over a period of time. So in terms of Section 23H, SARS limited that deduction. Okay, so the effect of it was that the SDA basically found that the contract that was initially signed for the incentive bonus, although it was for that contract of time, the benefit to Telkom had extended over the period. The benefit that Telkom had received in respect of that payment did not end at that point in time when the connection was made, but extended to the period of the connection period of the 24-month contract with the subscribers. And accordingly, Telkom's submission failed in this regard. And SARS was correct in basically limiting the deduction in the year of assessment in which the expenditure had been claimed. Okay. The next case is Big G Restaurants versus SARS. So Big G Restaurants is a franchise which operates a number of restaurants, in terms of your Spur and your Panarottis restaurants throughout South Africa. They had a franchise agreement with the Spur group whereby they would, whereby the franchisee would pay a franchising fee to the Spur group. And in terms of the franchise agreement, they were required to refurbish the restaurants at reasonable intervals as determined by Spur. Okay, during the period over a number of years, the Spur Big G Restaurant had claimed a Section 24C allowance in respect of the refurbishments that were supposed to happen subsequent to year end. SARS looked at it and basically disallowed the Section 24C allowances that were claimed on the basis that it did not meet the requirements in terms of Section 24C2. So if you read in terms of Section 24C2 of the Act, future expenditure under a contract will be deductible where the income of a taxpayer in any year of assessment includes or consists of an amount received or accrued to him in terms of a contract. And the Commission is satisfied that such amount will be utilized in whole or in part to finance future expenditure which will be incurred by the taxpayer in the performance of his obligations under such contract. So those are the important elements in terms of which the SDA, in which the SDA had looked. So what Big G Restaurants argued was that they had received the income in terms of the franchise agreements because the franchise agreements obligated them to sell food to the public in terms of their restaurants. And the obligation arising, the refurbishment of the, in terms of the franchise agreement was the obligation in terms of the franchise agreement. So they tried to link the earning of the income in terms of the franchise agreement to the obligation that was incurred in terms of the franchise agreement for them to claim the Section 24C allowance. So the SCA basically looked at what the narrow meaning of the words in terms of meant. And basically said, looks at the narrow and the wide meaning in terms of what it meant in terms of the word in terms of meant. And where it said that the narrow meaning is the direct, there must be a direct or immediate connection between the two concepts of the earning of the income and the obligation in terms of the contract. And in terms of the wider sense, refer to a loose or indirect connection relationship between the two concepts. Okay, so the taxpayer, they basically concluded that the taxpayer must earn the income from the same contract in terms of which the obligation incurred. So the SCA basically said that they started the Big G Restaurants did not earn the income in terms of the franchise agreement because the agreement was with the patrons of the restaurant who came in to eat, and the agreement was with the patrons to supply food, and that's how they got their income. So the franchise agreements did not earn the income. So there was no direct correlation between the earning of the income and the obligation in terms of the contract. So, and that reason, the Big G's claim in terms of Section 24C had failed. So just a heads up, in terms of where taxpayers claim allowance in terms of Section 24C, it must ensure that the income it earns and incurs the obligation under the same contract. So that's the take from the case at the end of the day. Okay. Then in Purveyor's South African Mines, That's the commissioner. This involved a voluntary disclosure case. Purveyors had imported an aircraft into South Africa, which was used for the transportation of goods and personnel within Africa. Purveyors became liable for the payments of import VAT on the aircraft that had imported into South Africa. So didn't pay the output tax in respect of the importation of the aircraft into South Africa. During the latter part of 2016, Purveyors engaged certain representatives within SARS to obtain a view on its liability for such taxes due and payable. So the people from Purveyors went to SARS with the set of circumstances that they found themselves in and asked the SARS representatives what was their understanding and what was their take on the issue that they found themselves in. So they gave them the facts. They gave the SARS officials the facts. Following these engagements, Purveyors was advised by SARS on the 1st of February 2017 that the aircraft should have been declared in South Africa and that VAT should have been paid thereon. So output tax on importation should have been paid thereon. But more importantly, it was advised that the penalties were applicable as a result of the failure to pay the VAT. And this is an important part in terms of the Tax Administration Act, where you decide whether a case is voluntary or not. So after a period of time, approximately a year later, Purveyors went to SARS and made a voluntary disclosure in respect of the importation of the aircraft. So SARS declined the request in terms on the basis that it did not regard that the requirements in terms of Section 227 had been met. 227 of the Tax Administration had been met. Because SARS was a view that was not voluntary in nature. So what is voluntary in nature? It's an act in accordance with the exercise of free will. So by Purveyors going to SARS in the initial stages, going across the counter to the SARS guys, SARS did not consider that as a voluntary disclosure at the end of the day. Why? Because in terms of Part B of Chapter 16 of the Tax Administration Act, a disclosure is not made voluntary when application has been made after the taxpayer has been warned that it would be liable for penalties and interest owing from its mentioned default. So in the email that the SARS officials had sent to Purveyors, they outlined that yes, tax would be payable, but also that warned them that they will be liable for penalties in respect of the default as well. So when the application was made, SARS was obviously aware of the default, so it was no longer voluntary in nature. What they should have done was either do an anonymous VDP disclosure to SARS, a no-name VDP disclosure, setting out the facts and let SARS come back to them. They shouldn't have approached the SARS officials directly, because the only way you can regularize your affairs is through the VDP unit, not by going to a separate unit outside SARS or separate persons within SARS to do your voluntary disclosure. So at that time, when the voluntary disclosure was made, SARS was aware of the default, and accordingly it could not be voluntary in nature. So what's to take out of this case is basically that SARS is not your legal or your tax advisors. We are your tax advisors. So should you need advice, please come to the proper people, such as your tax advisors, for the proper advice going forward. Okay. Then there was an unreported case which was recently decided in the tax court in Durban. The judgment was issued in February 2020. It was one of the cases that Yasmeen had previously dealt with. It involved Section 11B allowances, which is your research and development allowances, which we claimed in terms of Section 11B. It allows a deduction. Section 11B allows a deduction of 150% of your expenditure incurred for R&D purposes. So the taxpayer had a dedicated R&D department and dedicated personnel within the R&D department to carry out its R&D activities. And in terms of their setup in the general ledger, there are separate cost centers for the R&D activities where all the expenses have been posted. The issue in dispute between SARS and the taxpayer was whether the indirect expenses, or the general expenses in relation to the R&D activities were deductible were allowed to be used in the calculation of the allowance. SARS purported that only the direct expenses for the purposes of the R&D were allowed as a deduction. So SARS, in their submission in terms of their disallowance, in terms of the 11D calculation, they disallowed certain costs such as aircraft costs. These were costs that were incurred by the taxpayer, where they would need to fly out to different facilities, R&D facilities, to basically to the fields where the R&D was being conducted. They disallowed costs such as water and electricity for R&D, for the R&D department itself. The printing and stationery that was used within the R&D department, they are disallowed, and travel costs between R&D centers, computer costs where the computers were used for the purposes of conducting the R&D activity. So all those expenses where they said there weren't a direct hands-on approach to the R&D activity, those costs should not be included in the calculation. And the tax court basically contended that this was a narrow view of what was intended by Section 11D, and that the two separate instances where the word directly is employed in Section 11D1 govern distinct and separate outcomes. Firstly, expenditure on the R&D activity has to relate directly to activities that occur and unfold within South Africa. And secondly, the R&D activity must in itself be directly connected to the subject matter on the R&D. And those expenses were specifically identified, and cost centers were specifically created within the R&D department to cover all these expenses at the end of the day. So the R&D expenditure incurred by the taxpayer, this is the findings, the R&D incurred by the expenditure in terms of the taxpayer fit in those observations in the various heads of expenses that were incurred directly for the purposes of R&D. So all those indirect expenses that were utilized by the taxpayer in conducting the R&D activities were directly used for that purpose and that purpose only, which is the R&D activity. So, but for the expenses, the R&D activities would not have taken place. So you needed to incur those expenses for your R&D to take place at the end of the day. Okay. So that was a big finding for a big judgment in respect of although it's a tax court case, it's a big judgment in respect of R&D allowance claims at the end of the day. Because SARS, in our experience, have been disallowing all the indirect expenses and saying that only those hands-on or direct expenses relating to the R&D activity are allowable in terms of the calculation of your 150% deduction. Okay. Okay, another issue in dispute in this case was the Section 24C allowance. So the taxpayer had received income in advance in respect of certain goods which it delivered to his clients after year end. The taxpayer had the stock on hand, and in respect of those goods to be delivered at year end. So basically SARS, we knew it was going to be what the outcome of the Section 24C allowance would have been. The SARS said, the tax court basically said that the expenditure had been incurred during the year of assessment because the stock was on hand. Although it was capitalized in the balance sheets, the expenditure in respect of that income received in advance had been incurred and was on hand. So according to the Section 24C allowance as disallowed. So where you have income received in advance and you want to look at claiming a Section 24C allowance, you must first look at whether you have incurred that expenditure. And incurral of the expenditure means that if you still have the stock on hand, which is to be delivered after year end, the full amount will be subject to tax, but you cannot claim a Section 24C allowance because that expenditure has been actually incurred. Okay, and that's my presentation. I'll then take you on to Anushka.
Thank you, Bruce. Hello, everyone. Clearly, Bruce is much older than me. Okay, so today I'm just going to cover the Disaster Management Tax Relief Administration Bill. In March 2020, the Minister of Finance announced a number of tax relief measures to combat the COVID-19 pandemic. In June this year, the bill was passed by Parliament. And on the 25th of August, there was an amended bill that was passed in August as well. I'm just going to cover a few of the items included in the bills that are still relevant or that might still be a bit topical. The first is the deferral of provisional tax liabilities. Now, if you're a qualifying taxpayer, so that is a business that's conducted by a partnership, company, individual, or trust, with a gross income of less than 100 million rand, and not more than 20% of your income is derived from passive income or remuneration, and you are a tax compliant business, so that in other words, you are registered for all the taxes that you need to be registered for, and you have no outstanding tax returns or tax debt, then you could qualify to defer a portion of your provisional tax. And this is only for the 12-month period between 1st of April 2020 till 31st of March next year. So if your first and second provisional tax payments fall in this period, you would need to have paid 15% of your total tax liability or estimated total tax liability by the first provisional tax payment. And by the second provisional tax payment, you would have needed to pay 65% of your estimated total tax liability for the year. The remaining 35% of that provisional tax payment needs to be made as a top-up payment. So by the time your third provisional tax payment is due, you would need to pay that remaining 35%. Now, your third provisional tax payment is due usually 6 months after the end of your financial year. And in the case of taxpayers with February year end, by the end of September. If that amount deferred isn't paid by the due date of your third provisional, then SARS will levy interest on the late payment of your provisional taxes. So just want to highlight that. Moving on to the employees tax. Now, initially, qualifying employers could defer 35% of the employees tax withheld between the period 1st of April to 31st of July. On the 25th of August, the amended bill extended that deferment for an extra month, so until the end of August. And then the amount that's been deferred, the 35%, that has to be paid over to SARS in 6 equal installments. The first installment will be due on the 7th of October, and the last one due on the 5th of March next year. Here again, if the payments for those 6 installments are not made timeously and in the correct months, there will be penalties and interest for the late or non-payment of that 35% of employees' tax that's been deferred. With regards to the skills development levy contributions, this is the time period for this has already passed, but I just want to highlight this because there's been some confusion from many people whether this is a deferral of SDL contributions or it's a payment holiday. Basically, it's a payment holiday or an exemption to pay SDL for that 4 period. So there's no need to calculate the SDL and pay to SARS at a later stage for those 4 months. And then with regards to carbon tax, for those taxpayers, and there's not many that we are aware of that actually have this need to actually register and submit carbon tax returns. The first carbon tax return and payment was due at the end of July 2020. It's now been extended for 3 months till the 31st of October 2020. Then on the unemployment insurance fund, the temporary employee relief scheme, or the UIF TERS as everyone calls it. I'm not going to get into the detail on how it works, the calculations and all of that, but I just want to cover 2 things. One relates to the closing dates for applications. So there are, for the first period of between 25th of March and 31st of July, that closing date has now actually been extended till the 15th of September. And applications for the benefit for the period 1st of August to 15th of September, those applications close on the 30th of October. From a tax point of view, there's been a lot of views and queries regarding is that TERS benefit received by the employee taxable in their hands? And the answer is no, it is exempt from tax. Even if the UIC pays the TERS benefit to the employer and the employee then just passes it on to the employee, it's not remuneration and it's not taxable. You would just need to make sure you disclose it on the employee's payslip as a TERS benefit. So it must be disclosed separately. The next thing I want to look at is just two draft interpretation notes. The first relating to withholding tax on interest. Now, withholding tax on interest came in to our legislation in March 2015, and basically it levies a withholding tax on any interest paid on or after 1st of March 2015 for the benefit of any foreign person. So a foreign person basically is a non-resident, company, trust, individuals. There are few exemptions from the withholding tax on interest, and this is basically interest that is paid to a foreign person by the government of South Africa, any bank, or if it's in respect of any listed debt. The rate of the withholding tax is 15%, but this can be reduced in terms of a double taxation agreement. But please bear in mind that if you want to apply the reduced rate of withholding tax in terms of a DTA, it's not an automatic reduction. The recipient of the interest actually has to provide the payer of the interest with a withholding tax on interest declaration form, or the WTID. And this WTID now needs to be renewed every 5 years. So it's probably time to check if you do have WTIDs in your possession, whether the 5-year period has expired and whether you need to renew them. The payment of the withholding tax on interest needs to be paid by the last day of the month, so last business day of the month following the month in which the interest was paid. Now, I want to highlight that point of when interest was paid, because in terms of the legislation, interest is deemed to be paid on the earlier of the date on which it is paid or the date on which it becomes due and payable. And in many instances, we find that the withholding tax on interest isn't paid over to SARS because you may not have actually paid the interest, so you don't think that there's an obligation to pay the withholding tax. And a simple example would be if you had a loan from a foreign person, an interest-bearing loan, and in terms of the agreement, interest is due and payable quarterly or biannually, and you actually haven't made any interest payments during the year, so you don't think you would have needed to pay the withholding tax on interest. But because your loan agreement says it is due and payable, let's say due and payable, biannually, you would have had to pay the withholding tax over to SARS by twice a year. There's also a return for withholding tax on interest that needs to be submitted for each payment within the same time frame as the payment. And this form can only be submitted via e-filing. There's an additional administration obligation for the payer regarding withholding tax on interest. The first is the payer of the interest has to actually submit biannual reconciliations to SARS, as well as issue IT3Bs to the foreign person in respect of the interest paid to the foreign person. And moving on to withholding tax on royalties. Now, this tax has been in our legislation for a number of years. And it's the first time we're actually seeing a draft interpretation note or any guidance from SARS on this tax type. And basically, this is levied on royalties that are paid to a foreign person for the use of intellectual property belonging to that person, or for the imparting of knowledge or information relating to intellectual property. Similar to the withholding tax on interest, the tax rate here is 15%, and it can be reduced in terms of the DTA, provided the payer is in receipt of the signed WTRD, or the withholding tax on royalties declaration form. Here again, this also needs to be renewed after 5 years, so better check if you have valid WTRDs in your possession if you are using a reduced rate. Similar to withholding tax on interest, the return and payment must be made by the last business day of the month following the month in which the royalty was paid. And here again, royalties are deemed to be paid on the earlier of the date on which it is paid, or the date on which it becomes due and payable. Unfortunately, the WTR01 royalties form is still a manual form, and that still has to be submitted to SARS manually, either by email to SARS LBC or actually dropping it off at a SARS branch. Then just some developments at SARS. I'm sure a lot of you would have seen or heard about SARS sending out auto assessments, and basically from the 1st of August, SARS did send notices and auto assessments to non-provisional taxpayers. And what they did was they've, using the information received from employers, that's like your RP5s and IT3s, from financial institutions, so that's your, your IT3Bs, IT3Cs, and from your medical schemes and your retirement fund administrators. They've used that information to pre-populate the tax return for non-provisional taxpayers and calculate the taxable income, the tax payable or refundable. Now, if you've received a notification of auto assessment from SARS, you're required to actually review the auto assessment and then either accept the assessment or edit the assessment and submit it. It's just what I want to highlight is the importance of reviewing that information carefully before you actually accept the auto assessment, because there could be errors with the information. There could be either missing information or there could be incorrect information on that auto assessment. So please just check it carefully before accepting, because if you do accept it and information is incorrect, it could be seen later on as non-disclosure. The auto assessments need to be either accepted or edited by the 16th of November 2020, which is the filing season deadline for non-provisional taxpayers. And according to the SARS website, if you do not accept or edit the assessment, they will issue an estimated assessment after 29th of Jan 2020. With COVID-19, SARS has had to streamline its operations. And the two things that they've come up, the first thing they've come up with was making appointments with SARS. So they don't want people walking into a SARS branch without an appointment. They don't want people gathering there to, find out what's my tax number or help me file my return. They don't even want tax practitioners just walking in there. So they've got booking systems for appointments, and there's two systems. One, you can do it via an online system, and you use this to make appointments with SARS for video or voice appointments. So you don't even need to go in. You can sit in your office or home and have a video or voice appointment with SARS. Or you can call them to set up a video voice appointment, or if you need to go in physically to a SARS branch. There's quite a few functions that the video and voice appointments can be used for, so it's actually quite a nice feature, and I actually hope they continue with this kind of appointments even after the COVID-19 pandemic is over. The other thing they've done to streamline during this period is their online query system. So they've set up this online system for you to actually be able to submit supporting documents. Even if you're not an e-filing client, you can now submit supporting documents that they've requested for via this online system. You can request payment allocations as well as request a tax number if you've forgotten it. They've also streamlined their mailboxes. So I'm not sure if you remember, but previously we used to have a number of email addresses for the same thing. So for example, based on your region, you would send an email to contact.east@SARS or contact.central@SARS. Now they've just streamlined it for one email address for tax practitioners, one for taxpayers, and then they've added in 3 more if you want to submit supporting documents, or you want to find out your account balance, or request statements of account. So this is quite a nice feature. And that's it from me. So we're now going to take questions. Yeah.
Right. I see from our chat function, there's not too many questions. One person was just happy to see us again, and we're delighted to see you again too. And the other question was whether the recording will be available. Yes, it will be on our website, www.bowmanslaw.com. It should be available either later today or tomorrow. If you're having trouble finding it, please just give us a ring or drop us an email, and we'll arrange for you to find that recording. On our side, I don't see that there's any other questions. If you do have questions, please feel free to contact us separately. Thank you for joining us. We went over time a bit, but I hope you enjoyed it. I hope you got a lot out of it. From our side, we'll prepare the CPD letters and send it to you. I just want to say thank you very much to Bhuti and Notando for organizing this webinar, and to Anushka and Bruce for staying up late and preparing the slides. It's a bit different from the events that we normally host, but we've thoroughly enjoyed hosting you today. Hope to see you guys all in person soon. Hope we can get back to physical events soon as well. With that, I'm going to say goodbye. Take care, everyone, and I hope to see you soon. Bye-bye.